Hi everyone, my name is Piterpakulski. Today we'll continue building financial model of a clothing store, shoe store, or we can be discussing combined store. Actually, we are building a chain of 40 stores, and inside these 40 stores we have 6 types of stores. So we can have a small store, medium store, big store, store which has losses, for example financial losses. So we can create six types of stores and put them inside a chain which contains 40 stores in total. Today we will be answering another very important question, like what is the payback period of my business idea? And today I will be modeling a simple payback period diagram, which will indicate what will be the payback period. I will be doing that from scratch, so guys, like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model I will give you all the links in the description of this video as well, so you will be able to watch all tutorials absolutely free from scratch till the final overview. So I hope you enjoy all this financial journey. So first of all, I will give you a quick overview of what we did before during previous tutorials. So here we have yellow tabs. Each tab is devoted to this or that type of store. So let's dive into one of them. So we have a rule in our model that all inputs are colored with blue color, like this. So we have for each store we have two collections: spring summer collection and autumn winter collection. So first of all we specify when we start selling each collection, then we specify the product line inside the collection, pricing. We can switch on and off different items from the revenues. We have global and local coefficients for scenario play. We have sales plan for this season. Then we have global and local coefficients for sales plan. Then we specify the level of manufacturing costs from pricing. We have global and local coefficients for manufacturing costs. Then we are talking about price discounting. So when collection gets inside the store we have no discounts. Then the discount starts growing, so we can specify discounts to our product line. Then the next block of inputs is devoted to allocating of the sales plan. So we are assuming that, for example, 40% of sales plan will be sold during March, 20% of sales plan for this season will be sold on April. So here we allocate 100% of sales plan, so the amount of units. So for example 3% of units will be sold on September, so we can allocate the sales plan inside this area for different types of products. Then we're doing the same for autumn winter collection. When we start selling it, product line, pricing, sales plan, level of manufacturing costs, price discounting, sales plan then we are allocating manufacturing costs before we start selling this collection. So for example spring summer collection we start selling at March, and before March, during 6 months, we are allocating, so these are manufacturing costs, and we are allocating these costs in percentages 6 months prior, and these are the actual manufacturing costs during this period. So this is the moment when collection appears in the store, and 6 months before we have manufacturing costs. So this is the spring summer collection, this is autumn winter collection, the same logic. Then we are describing fixed costs. So here are the names of fixed costs. Amount, monthly amount, we can switch them on and off. We have global and local coefficients for fixed costs. Payroll, amount of people on each position, salaries per person on each position, we can switch on and off people on each position. Global and local coefficients. Then we are moving to the investment plan for this type of store. Here we're describing what we are investing in. This is the moment when the store starts its operating activity. And before this moment, during 6 month period, so we're assuming that we will be investing in this store during 6 month period. So 6 months before, we are describing how much we are investing and when we are investing. So this is the first revenues, and before these revenues we have 6 month period of investment stage. So we can switch on and off different investment plan items. We have global and local coefficients for scenario play. Then we are setting up the life cycle for this type of store. So for example, this life cycle will be 10 years. For example, if we will be modeling a store which will give us some losses, so we will be closing this store, for example, in a period of 2 years. So here we can specify the amount of months of operating activity for this store, for this type of store. Then we are assuming some asset tax monthly. Here we are setting up the speed with which this type of store reaches the target revenue. So we are assuming that when we open a store, it doesn't reach target revenues right from the first month. So it will reach the target revenues step by step. And these are the steps. This is very important block of inputs, because it can show us potentially some operating losses that we will have to add to the total amount of financing needed for the business. So that's why this block of inputs is very important for scenario play. So the same logic we have for all other types of stores. So this is store type 2, store type 3. Let's go to the core. So here we are setting up the first year of our projections. Then we have global coefficients to play with: pricing, sales plans, manufacturing costs, fixed costs, payrolls, investment plans, so we can increase and decrease revenues and costs right from here. Then we have 6 types of stores. We can name them, these portraits. We can switch them on and off from calculations. Then here we have a core. This is a very important block of inputs, where we have a chain of 40 stores, and each of these 40 stores can represent one of 6 types of stores that we've already described here. And in this table we are setting up what type of store we are opening, when we are opening this store, year and month. We can switch on and off this specific store from calculations to see the cash flow with or without this or that type of store. Then we are adding a loan, amount of loan, term of loan, interest rate, grace period for interest payments, grace period for principal payments. Then we are specifying when we get this loan, year and month. Then we are adding a management company. So we can add management company in three ways. The first way, we are adding management company when we are opening the first store in our chain. So this will be the variant number 1. Variant number 2, we will be opening the management company when the chain reaches, for example, 15 stores in our chain. So we can set up this parameter. And variant number 3, we can manually start a management company at a specific month and year. So we will be able to do that here. And then we are choosing among these three variants how we would like to open a management company. Then we can completely switch the management company off to see the breadth of the business without management company, how the business breathes itself. Then we are setting up management company fixed costs, payroll, management company investment plan, asset tax. Then we are setting up the tax rates. Then we are building finally the cash flow statement. Then we are answering how much financing is needed to start this or that scenario of our business idea. And now let's calculate the simple payback period of our business idea. So let's copy this table. Let's call it simple. So first of all, what we need to do, we need to take the result from operating activity plus the result from investment activity minus principal payments minus interest payments. Then we will extrapolate this formula to the right. Then I'm gonna add the previous value to make this line cumulative. And now I will extrapolate this formula to the right. So the truth is, so the payback moment happens when negative in this line turns to positive. So September 2025 will be the payback period moment. So this will be the moment when the amount of money that we put inside this project, loan plus equity, will be equal to the cash generated by the business itself. So this is the essence of this line. And if we want to calculate how many months, so this will be payback period. Payback period months. So here I will write a very simple formula. So if this is negative, I will put here 1, otherwise 0. Now I'm going to extrapolate this formula to the right. Now I will go here, create a total for this line, press enter, and now I know that the simple payback period of my business ID equals to 32 months. So for example, if I for example increase, for example, or decrease some the sales plan, for example, you can see how the data is changing. So what we can do now, we can create a diagram of this line. So I will just merge these cells. Now let's select this line. Then we will click Insert, Diagram. So this is a simple payback period diagram. Now what we will do, we will measure lines, select data, edit. Okay. So the payback period is the moment when this diagram crosses this line. Just a second. So if we go to this timeline, so this will be September 26. If we go to 26 is September, this will be the payback moment of the project. So this is the month when this diagram crosses the OX axis, the timeline. Here it is. So when the line, when red, when red turns to black is equivalent when this diagram crosses the timeline axis. So what we can do now, we can, for example, copy this table. We can go up, place this table, for example, here. Let's place it, for example, here. And we can, for example, play with sales plan. So later we will put here simple, discounted payback period, internal rate of return. For example, somewhere here we will be able to play with pricing, sales plan here, and we will be able to see in this or that scenario how much financing is needed, what will be the payback period, what will be the internal rate of return, what will be the net present value, what will happen, for example, if we switch off this type of store from calculations. For example, what will happen if we switch off this type of store from calculation? What will happen if we switch off this type of store from calculations? So we will be able to play with the data, with inputs very quickly, and you will be able to create a huge amount of scenarios to test your business idea. That's what we are fighting for. So you will be able to feel your project, you will be able to see how stable your business idea is. So you will know your business idea for the first time, and this is very valuable to know that beforehand, before you've invested your first dollar of savings. So that's why so this video is very important. So guys, please like, share, subscribe. You can always order financial models from scratch for your unique business ideas. We can help you with that. I will put at the end screen of this video, I will put the link to the playlist where I will be keeping all these tutorials, and when I completely finish this model, I will give you all the links in the description of this video as well, so you will be able to watch all tutorials from scratch, absolutely free, from the very beginning till the final overview. So thank you guys for watching. See you in next videos. Thank you and bye.